You know, a lot of people ask me what the infinite banking concept is and how they can get started. So I figured I would make a super quick and easy video explaining the infinite banking concept and giving you 3 steps on how you get started implementing this for you and your family. But before we do that, let me first start with what is the infinite banking concept. It's often called IBC, and here's all it is. It is the process of taking back the banking functions in your life. So what does that mean? Because you're probably like, oh great, process of taking back the banking functions in my life. Well, think about it. What are the banking functions in your life? First and foremost, number 1 is savings. So when you make money from working, you go out there and you trade hours for dollars, you run your businesses, you get paid, you get bonuses, you make money. Well, what is the first thing that you do with that money? You have to figure out where it's going to go. And where does your money go? It goes into a traditional bank. So step number 1, we have to change one thing. For the infinite banking concept to work, we must change where your savings goes first. Not all your money. I want to be clear about that. A lot of people want to have you put all your money into this vehicle, this machine, okay? But that isn't what I suggest. I suggest just your savings. And how much should your savings be? Well, if we look to the 6 laws of wealth, the first law of wealth says one must keep 10% of the money they make. So 10% is the amount you should be saving. So we should figure out where that 10% needs to go first. That's the first change. And what you're going to do is you're going to change that to be a vehicle that allows you to be in control of your money. Because when you put the money in a traditional bank account, you are not in control of that money. Who is? The traditional bank. So the first thing we need to identify is where that money needs to go. So for the infinite banking concept to really work the most efficient way, not the way that it works, but to make it work the most efficient way, what the founder, the late R. Nelson Nash, figured out is that 10%, that savings, the money that you would normally put in a 401k, put in a bank account, a CD, a brokerage account, we're going to change where that money goes first. I didn't say indefinitely, first. We're going to put it into a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Now I know that sounds against everything you've ever heard of where your money should go, because you should what? Buy term and invest the difference, right? Well, hold on. The specially designed and engineered whole life oftentimes includes term. So why? Well, because there's rules, and I don't want to get into them today. We're keeping this simple. But when you're going to change where your savings goes, there are a couple things you must consider. So this is all under how much should you put into the infinite banking concepts. Well, I said the minimum should be 10% of the money that you earn, because that's a law. That's the first law of wealth. But by definition, the very bare minimum that you can put into one of these specially designed whole lives in order for the infinite banking concept to work is 10 times your age. So if you're between ages 30 and 60 years old, it's 10 times your age. So how do you figure that out? Well, it's basic math, but I know they don't teach basic math anymore, so let me just tell you a simple way. Take your age. I'm 46, so 46, add a 0 to the end of it. 460, that's 10 times my age. $460 a month would be my minimum in order to start an infinite banking concepts policy. That's right. So if you're under 30, it's 15 times age, and if you're over 60, it's 15 times age. So that's the bare minimum. So what's the maximum? Well, the maximum can be any amount that you want to put in, as long as you qualify for that amount based on your income and your assets. So most insurance companies will allow anywhere between 20 and 40% of your household gross income. So how much are you able to put into this policy? Well, just do the math. Now, a lot of our clients will put money into the policies different ways. Some will do it the way I just mentioned. They'll put $460 a month into a policy because that's their minimum. Others will add a couple more zeros and put $4,600 a month. That's a monthly premium deposit. Some people will say, no, I like to save money annually, so they'll just do it on an annualized basis. So just take the $460 or $4,600 times 12, and they'll put that in one time a year. But you see, there's a lot of clients that would take and do a dump-in. So what is a dump-in? Well, a dump-in would be They've got a bunch of money that they've saved up inside of another account, like a bank account. They got all this cash sitting in somebody else's bank, and they're like, wait a second. The insurance company inside this specially designed whole life will pay me a higher interest rate and dividends, and it will be tax-free, and I can use the money with uninterrupted compound interest? Shoot, man. How do I put all my money in that? Great. It's called a dump it. And all you're going to do is you're going to basically take the money out of your bank, and you're going to dump that money into the policy. So if we dump the money in the policy, that money goes to work for you immediately, earning guaranteed interest plus dividends, and it starts compounding day one. And then you make your regular, premium deposits like we discussed earlier. So that's the way you can fund the policy. But you see, that's step number one, determining how much to put in. So let's move on to step number two, which is I think where we start getting into the fun part of the infinite banking concepts. Because now that the money's in the policy, your policy's issued and funded, now what do we do? Well, now the number one goal is what we want to do is we want to take that money that we put into the policy and we want to find a place for that money to go to work over here. So we got all the money over here. Now you know you're earning interest and dividends on all of that money, and that money then can be borrowed against. Yes, the insurance company will lend you up to 60 to 90% immediately of the money you just put in there. So you put 100 grand in the account with dump-in and premium deposits. Now you can take anywhere between 60 and 90,000 out. But where is that 60 or 90,000 going to go? And folks, if you don't have 100 grand, great, do that on 10,000. If you don't have 10,000, whatever your number is, I'm just using easy numbers for math. That's all we're doing, okay? So if we've got 90,000 bucks or 60,000, depending on your design, let's go right in the middle. I put 100 in and I can take 80,000 out. It's important to understand, where does that 80 grand go? This is my hard rule. That money can only go one place and one place only, and then that is debts. Because if you've got debts, we got to get rid of them. But let's define good debt and bad debt. See, bad debt would be credit cards. Bad debt would be high interest rate loans or high interest rate lines of credit, whatever. We want to get rid of them first, because mark my words, the fastest way to wealth is through your own debts and expenses. Let me explain. You've got credit cards, and the average interest rate that you're being charged on those credit cards, let's just call it 25%. So if you're giving away 25% every single month on those credit card payments, wouldn't that be cool to earn 25% on that 60 to 90,000 bucks that we said we're just going to use 80, put 100 in, and I got 80,000 bucks, okay? So I got 80,000 bucks. Let's say I got $80,000 in debts. I'm going to take the loan from the policy and I'm going to pay off the $80,000 in debts that I have with an average interest rate of 20%. Do you follow what I'm doing here? I paid off debts that had an average interest rate that I was being charged of 20%. Great, now all those debts are paid off. But you see, that's not the infinite banking concept. That's just the start. Think of this as a circle, folks. You got a circle. Your money starts on the left side of the circle right here. And then the goal is we want to move that money around the circle to the right side of the circle. And I call that the opportunity zone. In this case, and in all of your cases, if you have debt, that's where it starts. But we're really taking care of bad debt first. And I used high interest rate credit cards and lines of credit. So we paid all those off. But every single month, you used to make a payment to those debtors. So now you're still going to make a payment, but that payment is going to go back to your bank, which is a specially designed whole life where the money started. Oh, and by the way, where all the money still resides. See, all the money is still in the policy, earning interest and dividends. So when you took the loan from the policy, the 80,000 bucks, whose money did you take? You took the insurance company's money. The insurance company advanced you part of your death benefit in the form of a loan, and they charged interest on that loan. Today, it's a little less than 5% for most of the carriers we use. Now that can change, okay? It's not fixed, but 5%. But the policy is paying you more than 5%, so you're making a spread. So now I paid off all those credit cards, and what you're gonna do is now you're gonna take the payments you used to give the credit cards and take them around the bottom part of the circle, and you're gonna put them back into your policy as a loan repayment. You see, this shouldn't be difficult for any of you to understand, because you do this today. You make money and you put it in somebody else's bank, okay, because you haven't learned about this yet. You take the money from somebody else's bank and you pay your debts. And those debts never, ever, ever make their way back to your family. That money's gone from your family forever. And all you're doing now is the exact same thing, except for the payments that used to be gone forever. You're making those payments back to your policy because that's where the loan came from, is your banking system. And when you pay your policy back, you reduce the loan, which means you reduce the amount you owe the insurance company in interest, because the lower the balance, the lower the interest they charge, but your money never stopped earning interest, so your money is compounding up. See, one is going up, your money, one is going down, the money you owe the insurance company. You see how you make more and more money using the infinite banking concepts? Because you just took back the banking functions in your life. You, not their bank, is making a spread and making uninterrupted compound interest. You, not their bank, is getting the payments at whatever the interest rate is. We just use 25% or 20%. That's coming back to you. So you're making money twice because you're making the spread, what they pay you versus what they charge you, the insurance company, and you're also making the money you gave away, which now comes back and is available to you every time it hits your policy as a loan repayment. And every loan repayment, although totally accessible to you, reduces the loan that you borrowed from the insurance company, which was in advance of your death benefit. You see how this works? It's so freaking cool. Is it starting to make sense? But I know there's still some of you saying,
yeah, Chris, but why wouldn't I just do that from a bank account instead of this stupid whole life policy you're telling me to do?
You could, but if you had 100 grand in your bank account and you took 100 grand out, how much interest is the bank paying you on that 100 grand? Zero. Any more questions? The insurance company allows you to use your money without stopping the flow of compounding interest. And if you don't understand that, then please pause this video, go to Google, and Google compound interest. Yes, right. You know what you're going to find? You're going to find what Albert Einstein said. He called it the eighth wonder of the world, the most powerful thing in the financial universe. And he said, those that understand it, earn it. I just told you how to earn it. He said, those that don't, pay it. That's for those of you saying that question. So I would leave that with, if you have any questions, put them right down in the chat. And let's pause for a second. Matter of fact, why don't we do something even more fun? Why don't you click that subscribe button while you're at it? Because by clicking that subscribe button, you can actually comment on this video, and you can see all my other videos by clicking that little bell that came up top. Smash that bell and give it a right hook. I always hit somebody with that, but anyway, that will notify you every time I put a video up. So let's continue on. A lot of people will then say, okay, well now I've paid off all my bad debts. What's next? Do I pay my mortgage off? Well, that's up to you. We could pay your mortgage off, but the reason we'd want to pay your mortgage off is one reason and one reason only, because most of you probably have a pretty low interest rate on your mortgage because you probably bought it when interest rates were low or refinanced it when interest rates were low. So a lot of people think, oh, I don't want to pay off the mortgage when it's going to cost me 5% to borrow from the insurance company and my mortgage rate is 3%. Here's what you're missing. You're missing that the bank isn't actually charging you 3%. Yes, it's amortized over 3%, but you're losing to the velocity of money. Look at your mortgage statement. Okay, if you've got a mortgage and you're in your first 7 years, which most of you are, look at it. How much of your monthly mortgage payment is going to interest and how much is going to principal? I'm going to repeat what I said earlier. Any questions? It's probably 60 to 80% of your payment is going to interest, and then a measly little amount is going to principal. Do you know why? Well, let me take just a moment to decompress this, because this is an important topic. You see, banks are really smart, and banks know that the average person will change homes or refinance their homes every 5 to 7 years. Why every 5 to 7 years? Because that's a short-term debt cycle, silly. Every 5 to 7 years, we ride this little cycle. It's called a short-term debt cycle, which means rates are low and then they're high and then they're low and then they're high. Okay? So that's why. Because they know that individuals are always going to be chasing the tail of what they call the fancy intro rates. Okay? The 3% or 4% fixed rate for 30 years. Oh, that's great. Yeah, it makes a lower payment. Doesn't mean that you're getting ahead any faster. You're just paying a lower interest rate, which means a lower payment, but it doesn't mean that those payments you make to the mortgage, it doesn't mean more is going to principal in the early years. The bank's always going to win. So why should you pay your mortgage off? Not because you want a better, not because it's a high interest rate, but simply because you're losing to the volume of interest. That's why. And people always ask me, well, how long is it going to take to pay off my debt? I don't know. Have we done a call yet? Do we know what your debts look like? Do we know if you've ever actually figured out how long it would take you if you just took the amount you're saving and paid off your debts? But here's what I do know. I've got hundreds of case studies. But let me give you one, a chiropractor who we met, who was saving $25,000. We said if you took 25 grand you were saving and you just went to pay off these debts, which were about $478,000. That's what his debts were. If we just took your savings and every year applied it to your debts, it'll only take you 19 years to pay off all your debt. How's that? Oh, not good. Great. Well, if we just change where the money goes first and we put it into the policy, and then we use the infinite banking concept to then recycle and recapture all the money that you're giving away when we pay debts off, how long would it take? 6.5 years. 19, 6.5, and that chiropractor didn't have to work any longer, any harder, or take on any additional risk? Nope. Just changed one thing, and that was where the money went first, and then added one step, and that was the infinite banking concept. Yes, folks, I have hundreds of case studies on this YouTube channel that allow you to see how that's done. Just go to the case study section or the playlist and watch, and you will learn. Matter of fact, subscribe to this channel right now and click that little alert button so you don't miss any. All right, so now you've paid off all your debts. I know it took a few years, but now that you've paid off all your debts, you're now recapturing a whole bunch of money that you used to give away. So what's next? Well, this is the point where we got to start thinking about all the things that we finance in our lives. Things like cars and boats, and for some of you, airplanes. Well, I know that's a small percentage of you, but just think, anything that you finance. Could be refrigerators and stoves and air conditioning units, for crying out loud. They allow you to finance everything. Well, you are not going to finance anything from someone else's bank ever again, because you've already learned how to be your own bank, right? You no longer need their bank when you've got your own bank, and your bank is now capitalized. Your bank now has a bunch of money recycling and recapturing back into it. So what are we going to do? Well, now we're going to start financing everything else that you would buy. Your car, your significant other or spouse's car, your kids' cars. That's right. Teach your kids how to be the bank. When they're 16 or 17 and they want their own car, say, hey, listen, I will lend you money for the car and you will make monthly payments back to our private bank. Teach them how the family banking system works and how you get all the money back for every car you ever buy, drive, and own. Oh, that got your attention? You want all the money back for every car you ever buy, drive, and own? What? I already showed you how to do it. It's exactly the same thing. You see, when you find a car you want, remember you've got all that money sitting in your banking system over here on the left side, all that money's there, and you identified a car you want to buy. I don't know, let's just call it a brand new Toyota Camry. Fill the blank in, whatever car you want. We're going to use a Toyota Camry. So we then take the 30 or 40 grand out of your policy and we pay cash for the car. Now I know you've always heard that paying cash is bad, but not in this scenario. This is your bank. By taking money out of your private banking system, which is that specially designed whole life, the money never left the account. Matter of fact, all that money's in your account earning interest and dividends, remember? So taking the money out to pay cash for a car really makes a lot of sense. Now that you've bought the car and you've got a loan against your policy, what you're going to do is you're going to figure out what the monthly payments would be on that car. Now, this is even easier than you can even imagine. When I go to the dealership and I look at a car, I make them figure it out. Hey, Mr. Finance Manager, can you tell me what the lowest monthly payment would be on a 5-year loan? Search all the banks out there. And they do a little search, and they come back and say, oh, sir, on that car, the lowest payment would be $600 a month. Great. What bank? Ally. What's the interest rate on that bank? 7.43%. That's the lowest I could find. Perfect. They just did all the work for you. They found the cheapest monthly payment out of all the banks in the world. So now what are you going to pay your bank back? The exact same amount. You're going to pay your bank back that 7.43%, which is $600 a month. So you're going to set up a bill pay for $600 a month every month. And what's going to happen? That money's going to come back over to the policy. And every month you got $600 in your policy. You've reduced that $40,000 car loan, the loan against the policy, so you're paying less interest to the insurance company. And every month you're making a car payment. But the car payment ends up back in your account, which is accessible the next day. So you can finance all the things. Now, once you're done financing everything, so as you keep doing this year over year, car after car, boat after boat, the only thing that can happen is you're going to get all the money back for all those things you buy. But you're probably going to start making money. Because remember I mentioned the spread? Okay, remember how the spread keeps going up? That's right. So now you're actually making a bunch of money. Eventually, what you may want to consider is buying your actual primary home. You could take the money from the policy and buy the house. Make the mortgage payment you would give to their bank back to your bank. What happens? You get all the money back. Duh. Okay, and then once you're done buying things that you normally would finance for your own self, now what you can start doing is becoming the bank. And who does the bank lend money to? Other people. Okay, I used to go to the bank all the time and borrow money from my apartments that I bought. So now, if I wanted an apartment, well, I would just take a loan from my bank and I'd buy that apartment. Then I would take that net rental income and I would put that net rental income back in my bank. Is this all making sense? It's just a circle. All you're doing, folks, is practicing a process called the infinite banking concepts. Of taking the function allows you to take back the banking functions in your life. That's all you're doing. I'm just giving you a bunch of different examples. Folks, this is not complicated. It is a bit of work, but here's the best part. If you work with us, now in order to work with us is simple. In the description, there's a 90-minute video. You watch that video because it's going to give you all the specifics. And it's even going to show you that chiropractor and how he paid off $478,000 in debt in 6.5 years without working harder, longer, or taking on any risk. It's going to show you how to get all the money back for every car you buy, drive, and own, showing 2 different car purchases. So the video is essential. Watch the video and then book a call and we'll talk about your situation. That's how you get started. And some people would be like, yeah, but I don't know who to lend money to. Well, I solved that problem for you too. It's called privatemoneyclub.com, where I bring people like you with money together with people that need money for those real estate investments that they're looking to buy. So privatemoneyclub.com will solve that problem. So get in privatemoneyclub.com, costs you nothing, create a profile and start looking at deals. And that allows you to BYOB, be your own bank. And it's just rinse and repeat over and over. Folks, I've given you the secret sauce. I've literally shown you how to create a banking system. I've shown you how to create a banking system, and the only thing you have to be able to do is save money, because you got to capitalize your bank. Now, I know some of you can't save money. That's okay, because what you now know is if you could, and if you get yourself to a point where you can, this is what the rest of your life could look like. You will be your own bank. You will own and control all of your money, and your money will always work for you 24/7, 365 days a week for the rest of your life. Doesn't that sound good? Because we've been lied to our whole life that the only way we get ahead is to work harder, work longer, and take on more risk. I just told you that isn't the formula. The way you get ahead is to make your money work for you so that you don't always have to be working for money. But yes, you got to work for money to make the money to capitalize the bank, but once you capitalize your banking system, your money, this stuff, goes to work for you. And it doesn't complain, it doesn't strike, it doesn't take lunch breaks, it doesn't need vacation. It works 24/7, 365, and it wants to work for you. So what are you waiting for? It's time for you to get started. It's time for you to become your own bank and take back control of your money. So check that 90-minute video out, and we'll see you on the next one.